Hey folks, so I haven't made a video in what seems like forever, but Apple earnings just came out and today it's down quite a bit. So I did just want to make a video about that. And this is going to be more on a financial statement point of view. So this is going to be very beginner friendly, and I'm actually going to provide this workbook with you as well. So I'll go ahead and put a link down to this in the video description so that you guys can view it and just kind of look at it on your own time. So let's just kind of start with the beginning, okay? So when the earnings come out, there's going to be the statement, and it's going to be on the newsroom. So I went ahead and provided that link to you. And basically, they're just going to give you a brief overview. So they're going to say right here, Apple today announced financial results for its fiscal 2023 third quarter ended July 1st, 2023. Now they're going to give us some key numbers right here. It says the company posted quarterly revenue of 81.8 billion. So we write that down real quick. It says that's down 1% year over year. And quarterly earnings per diluted share of $1.26, which is up 5% year over year. So we put all of that information down, right? Now, how do you perceive these numbers, okay? So revenue has gone down year over year, but earnings per share has gone up year over year. So now we have to think about how earnings per share is calculated. So earnings per share is essentially net income. So I'm going to write that down right here. Net income divided by shares outstanding. All right. So if we do net income divided by shares outstanding, that's going to give us earnings per share. So if earnings per share is going up, that means one of two things. It means net income is going up or shares outstanding is going down. Or it could be a combination of both. So I guess it means one of three things. Now, right here, we know that revenue went down. So essentially, that could mean that, okay, well, maybe our cost went down and that's what's making net income go up. Or maybe our shares outstanding went down and that's creating this higher earnings per share figure year over year. So that is how you perceive that information right there. So this is kind of just going to wet your brain just a little bit. And then now we want to go ahead and jump into all of the financial statements. So the balance sheet, I'm just going to give a brief overview right here. So, the balance sheet is pretty much just a snapshot at the listed date. So right here, you got your July 1st, 2023. So this is what they have on the books at this point in time. And then right here, they have September 24th, 2022. And you want to do a comparison. So they pretty much call this horizontal analysis because you're comparing over time. Now, if I'm just looking at this right here, so let me just go ahead and push it over to the left right here. So when you're looking at a balance sheet, it's usually organized in terms of liquidity. So that means that the most liquid item is going to be at the top. So cash and cash equivalents, marketable securities, and accounts receivable. These are going to be your most liquid items. Now, once you get to inventory and everything below that, that's a little bit harder to get rid of. And if we're looking at this tab right here, this is current assets. So current assets usually implies everything that is within 1 year. And then when you're looking at non-current assets, that usually implies something over a year, something that has a long lifespan. So, you're going to go down and you're going to see liabilities. Non-current liabilities usually means liabilities that are due over a year. And then normally you'd see current liabilities as well, but it doesn't seem like they have it listed here. So usually what people like to do is they'll take ratios. So they'll analyze their asset to liability or things like that. So, there's something called the current ratio. And what they're doing there is, they're looking at the current assets to the current liabilities. And that essentially gives a picture of how the company is able to pay their short-term debt. So that's pretty much how people look at the balance sheet. And another thing that you need to know about the balance sheet is assets minus liabilities plus equity equals 0. So that pretty much means that assets is equal to liabilities plus equity, or you could pretty much change change this around in the formula. So if we were to say assets minus liabilities equals equity, that is also true, and that makes sense, right? So just think about owning something. Okay, if you own something, but part of that you are able to own it because you have debt on that, then how much of that do you really own? What you really own is pretty much the money that you put in. So if you bought a house, okay, let's just say that you bought a house and you put in $100,000 of your own money, and let's say $400,000 of that was actually purchased with debt. All right, so the whole asset is worth $500,000. So if you do $500,000 minus that $400,000 of debt, that means that you have $100,000 worth of equity in there. So that is how that works out. So now we're going to go over to the income statement. And here we're going to do a little bit more a detailed analysis, just given that this is Apple. It's a massive tech company. And we want to know what's going on with their revenue, especially their revenue growth, because this is going to give us an idea of how much we actually want to pay for it. Obviously, you would pay more for a company that has a lot of growth. But if that growth is starting to subside, then it might not make as much sense paying a lot of money for that company. So let's just kind of talk through this. So right here, they have net sales, and then they have products and services. So they break down their sales into these two categories right here. Now, they also have this 3-month and this 9-month. So I like to look at the longer time frame. So if I'm looking at the longer time frame right here, we're looking at products and services, and we're comparing from June 25th, 2022 to July 1st of 2023. So, this is what we're doing. We're basically taking this amount and then we're subtracting it from the prior year, and then we're dividing it by the prior year amount. So that is actually going to give us our growth or decline. Now here in this case, if we're looking at the products, we actually had a revenue decline of 5.85. So that is not good. That's a bad situation. Now right here for services, we actually had a 6.69% increase. So that's good. Now if we go back to the basic info tab right here, they mentioned something of that sort. So let me just kind of go through this a little bit. So bear with me here. I just need to find that exact portion where they mentioned that. So it says, let's see. All right, it says, our June quarter year-over-year business performance improved from the March quarter, and our installed base of active devices reached an all-time high in every geographic segment. And then right here it says something, 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 something. All right, so that wasn't it. So let me go back up. They mentioned it somewhere right here. All right, so right here, they said, we are happy to report that we had an all-time revenue record in services during the June quarter, driven by over 1 billion paid subscriptions, and we saw continued strength in emerging markets thanks to robust sales of iPhone. So right here, they did mention something about their services revenue being at all-time highs. So, how much significance does that have? So now we're going to look at something, and we're going to look at margins. So if we're looking at margins, margin is pretty much, all right, well, how much income is left over from this? So, if you're pretty much selling a product, okay, so let's say you're selling a product, and let's say it costs $100, right? But you're selling it for $300. What is your margin? Your margin is what's left between. That's $200. So when we're looking at product margin and service margins, there's going to be a cost associated directly to the production of the product and production of the services. So when we take out those costs from that revenue, you're getting the margin that's directly related to that. So right here, the way that we calculate this is we're getting 1. So 1 represents 100%. And then we're going to do minus this 146,696. So where am I looking at this? I'm looking at this right here, that 146,696. So this is the cost, right? So that cost divided by the sales. So 146,696. And then we're going to divide that by 230,901. And then from that, we're going to do 1 minus that amount. So 1 minus that amount is going to give us our margin. So here we see that 36.47% is our product margin. That means that about 36 cents for every $1 of sales is retained. Now, on the other side of that, we're looking at the service margin. So that means about 71 cents out of every $1 of sales is retained. So obviously, it's better to have more service revenue because the margins here are higher. So that is something very important that you need to pay attention to. If we have more service revenue, that's much, much better than the product margin, because the product margin, you can see, is only 36.47%. Service margin is 70.79%. So another thing that we want to do is we can compare to prior year. So if we're looking at prior year, we can see that the product margin was 36.76, and we can see that the service margin was 72.16. So prior year margins were actually better. So that essentially just means that the cost in 2023 was higher. So that was eating into our margin. So that's not necessarily a good thing. But what is a good thing is that we are seeing that services revenue go up. But the actual product revenue, that's going down. So it kind of balances it out. But then at the end of the day, when we're looking at total net sales, it's down 3.42% compared to that 2022 in June. So ultimately that's not a good sign. You want to see revenue growth, not revenue deceleration. So overall, I'd say the revenue side is a miss, but it is nice to see that services revenue are increasing because the margins here are higher. So, it's kind of a mixed bag, but ultimately I'd say it's probably a little bit more on the negative side here. Now, if we're looking at operating income is pretty much what you want to pay more attention to. Now, I know everybody is interested in net income, but net income is looking at other things. So it's looking at this other income and expense, and that's not necessarily tied to the operation. So if we're looking at operating income, that is directly tied to the actual operations of the business. So this is very important to pay attention to. Every now and then, you'll have one-off expenses or something that show up in other income and expenses that really cause the net income to go seriously negative. So always pay attention to this operating income. That's pretty important. Now, if we're looking at the operating margins, as of July 2023, the way that we're calculating this is we're pretty much just getting that operating income, and we're dividing it by the sales. So right there. So right here, we have 29.73% as our operating margin for July of 2023. And that's comparing it to June of 2022, where we had 31% operating margin. So our operating margin went down. So that's a bad thing because you want operating margin to go up. Remember, this is saying that about 30 cents of every $1 of sales is being retained. Right here, 31 cents of every $1 of sales is being retained. So obviously, you would want more operating margin. That would be a good thing. But here it's actually going down a little bit. So that's a bad thing. But it's not down by a massive amount. So nothing crazy to worry about. Now we're looking at diluted earnings per share. So in this case, we're looking at something over time. So that's that's horizontal analysis. What we did right here, this is vertical analysis. So you're going to hear these terms being thrown around. So when I say vertical analysis, that means what I did right here, this operating margins. So I got this operating income and I divided it by that net income. Or by that net sales. So what we're doing here is we're looking at this vertically. But then when we're doing this calculation right here, this diluted earnings per share growth or deceleration, I am looking at this amount versus this amount. So we are looking at this horizontally. So this is horizontal analysis right here. So what I'm doing right here is I'm getting the current year amount, I'm subtracting it by the prior year amount, and then I'm dividing it by the prior year amount. So this is down 3.11%. That's a bad thing. And if we're looking at diluted shares outstanding, we're also doing horizontal analysis. So I am comparing this to this. And it went down by 3.27%. That's a good thing. That essentially means that they were repurchasing shares. So, I do have that link right there if you do want to go over and look at these financials. Now, let's go ahead and look at the cash flow statement. So the cash flow statement is probably what confuses people quite a bit. So when we're looking at the cash flow statement, we're doing something called cash versus accrual. So, when these guys are recording income or revenue or whatever, they're doing this using accrual accounting. And cash accounting is pretty much just looking at when you're receiving the cash. So if I sold you something, let's say that I'm going to sell you something, right? And then you give me the money for that. And then I'm going to deliver it to you. So under cash basis accounting, when you give me that money, I can record that as revenue right away. But then under accrual accounting, I can only record that revenue when there is a performance obligation that is met. So when you actually receive that item, when the item is delivered to you, that is when I can record my revenue. So when we're looking at cash versus accrual, this has a lot to do with just timing differences. So here, when we're looking at a statement of cash flow, they're basically undoing all of that accrual accounting and then getting it back to cash accounting. So that's essentially what they're doing. Like this is literally, okay, well, this is how much cash was generated as of now versus accrual accounting, which is looking at all these different timing differences. So right here, we're basically looking at the operations. So if we're looking at cash generated by operating activities, and we're looking at this 9-month ending. So, they made quite a bit. So if you just look at this, 3/4 worth of cash right here is pretty much, it's like 88 or $89 billion here. So they're making quite a bit. So definitely something that is pretty impressive in my opinion. So this is why Apple is so highly sought after, because they are just making so much money. I mean, literally look at that. $88.945 billion. That's a lot of money. So some things you want to pay attention to. Depreciation is not a cash expense. So when you're looking at something like depreciation, we're basically purchasing a long-lived asset. And instead of just expensing it right away, we're expensing it over time. So let's think about it this way. If I were to buy a bunch of office supplies, okay? Like let's just say I'm buying paper clips, I'm buying some paper, I'm buying some pens and pencils. I'm going to expense that right away, right? I'm not going to put that on my balance sheet. So I'm not going to spend all this time to put down pen, pencil, paper clip, and paper on my balance sheet, right? I'm just going to expense that right away. That's an expense. But something like a building, I'm not going to expense that. I'm going to do something called capitalize. So when you capitalize something, that means that you put it on the balance sheet. So if I purchase a building that's worth $500,000, that goes on my balance sheet. And then I'm going to expense that through depreciation over a certain amount of time. Basically, the time that they estimate that that building's useful life expires. So if you're looking at like commercial buildings or something, I believe that's like 39.5 years. So you would pretty much just get that amount, and then you would expense it over that amount of time. And then that essentially lowers your income, which gives you tax benefits. So that is essentially depreciation. We already spent the money, but now we're expensing it. So in a cash standpoint, there's actually no cash going out. So we add that back in. But under accrual, we actually expense that. But then here in cash, nothing is actually going out. So we add that back in, if that makes any sense. And share-based compensation is kind of the same idea, where we're paying employees with equity. So there's actually no cash going out. So we add that back in. So notice how we start out with this net income amount, and we're adding things back in, we're subtracting things, and then we end up with this cash amount. So that's essentially what we're doing in the statement of cash flows. Now, right here, we have investing activities. So, big companies like Apple, they'll purchase bonds, they'll purchase municipalities, and they actually put their securities that they purchase on the 10Q. So the 10Q is pretty much the form that comes out every single quarter when they have earnings. So right here, I said refer to tab 100.1 to see how they invest. So let's just go there real quick. So you guys can see, okay, well, they're putting their cash in money market funds, mutual funds, and then they're also throwing their cash in United States Treasury securities, municipalities, commercial paper, all of this stuff. So this is how they're investing, right? Now, let's go back to that statement of cash flows. And then right here, financing activities. So this is pretty much showing, they're spending money on the repurchase of stock. They're spending a lot of money. That's like 56.54 billion right there. But, the prior year, they spent some more money. They spent about 65 billion. So they're actually spending a little bit less here is how you can perceive that. And then I put right here, refer to tab 100.2 for more information. So if we go over to tab 100.2 right here, you can see right here, they have this note. So when you actually go into the 10Q, they have all of these important financial notes. Now, note 7 is going to be talking about shareholders' equity. And here they talk about the share repurchase program. So I'm going to go ahead and read this for you. It says, during the 9 months ended July 1st, 2023, the company repurchased 365 million shares of its common stock for 56.1 billion, including excise tax due under the Inflation Reduction Act of 2022. So if you guys do remember, the IRA, the Inflation Reduction Act, they started charging companies for buybacks. And I forget what that exact amount was, but I think it's like 1% or something. So this 56.1 billion is excluding that excise tax. And then right here it says the company share repurchase program do not obligate the company to acquire a minimum amount of shares. So basically, if they say, hey, you know what, we authorize X amount of money to purchase these shares, it doesn't mean that they have to use all of that. So yeah, basically they spent $56.1 billion right there. And they repurchased 365 million shares of its common stock. So that's causing shares outstanding to go down. That's going to make earnings per share go up. So that's the correlation right there. And right here, item 2, this kind of just shows just the average price that they're paying per share when they're repurchasing all of these amounts here. So in April 2nd, 2023 to May 6th, 2023, on the open market and privately negotiated purchases, they're making purchases that average about $165.46 a share. They purchased about 38,121 shares. And that's pretty much what's going on here. So it's just giving like an average idea of how much they're actually paying. So this just happens all the time because Apple is always buying back their shares. And they spend so much money buying back shares. So that's one thing that you do have to be aware of as a Apple investor, is that you're always going to have the company on your side just repurchasing a crap ton of shares. And a lot of this is done by just their actual issuance of bonds and notes and stuff like that. So Apple has highly rated corporate bonds. So when they issue these bonds, they're getting a lot of proceeds from that, and then they're using those proceeds to essentially repurchase stock and things of that nature. So that's a very good plus to have on your side if you're an Apple investor. Now let's go over to price to earnings. So if we go over to this website, it's called Macro Trends. They're going to give us this analysis where they show us the PE ratio over a long period of time. So here we're looking at about 13 years. And we can see that this is mostly averaging sub 20. So, I would say probably around like 15 to 20-ish is what you would see as the average PE ratio over the history of Apple. But then recently in 2020, you saw this really pop, and it went as high as 30 plus. Now we're back in these high areas. So you can see in 2022, when we had that slump, we were going to the low 20s. But this got bought up pretty quick, and now we're at 31. So now you have to wonder, okay, well, is 31 a decent price to earnings ratio to be paying for Apple? So now we're going to look at some different things here. All right, so how do we actually calculate PE ratio? Well, PE ratio, first we have to calculate earnings per share. So this is earnings that is the previous 12 months. And then we divide that by the number of shares outstanding, right? And then from this, we calculate the PE ratio. So the PE ratio is the share price, and the share price is going to change all the time. And then that's going to be divided by the earnings per share. The earnings per share only changes every quarter. So let me just show you this earnings per share calculation. So we do something called a trailing 12 months. That means the most recent 4 quarters of earnings per share. So the most recent one was $1.52, followed by $1.88, $1.29, and $1.20. Now we want to use diluted earnings per share because that's a little bit more conservative. It's considering the potential of dilution in the number of shares outstanding calculation. So when we're adding 4 quarters, that's $5.89. And then, okay, well, what is the share price of Apple? Well, the price is $181.99. So $181.99 divided by $5.89, that is 30.9. So what we have here is pretty much exactly right. Now that's not always the case, but I guess in this point in time it is. Now right here we can perceive that Apple is actually a little bit overpriced because, like I said, on average this is around like 15 to 20. So at 30.9, that's kind of high. And we could do one more thing. We could look a little bit further into this and look at historical revenue growth. So we could look at this quarter over quarter. So this is pretty much just comparing one quarter to the next. Or we could look at this year over year, where we're comparing one quarter and then we're comparing the same quarter in a different year. So if I'm doing a year over year calculation, what I'm doing is I'm looking at this date and then I'm looking at the prior year same quarter right here. So then what we want to do is we would essentially get this quarter and this year amount, subtract that from the last year same quarter amount, and then divide it by the last year same quarter amount. So when I do that calculation right here, we're down 1.4% year over year for this most recent quarter. Now, the prior quarter, we're down negative 2.51%. And then the quarter before that, we're down 5.48%. So, obviously, the trend data is not looking too great. And then, here's another thing that we would want to do. We would just want to look through all of this data, and then we'll just kind of look at some trends right here. So right here, we can clearly see that we had a strong period of year-over-year revenue growth. And then right here, we're kind of going through this slump. And then right here, kind of flattish. We had that strong growth again, and then slump. So these are things that you do want to pay attention to. Like you want to think, okay, well, what's going on in this period of time? Okay, what's going on in 2014, 2015 that's causing this massive revenue growth? What's going on in 2016 that's causing this slump? And why aren't we seeing that much revenue growth in 2019, early 2020? So these are all things that you do want to pay attention to. Also, hey, why was growth so high in 2020 through 2021? I mean, did this have anything to do with all the stimulus checks and people purchasing iPhones? Probably. So now, we're seeing that slump. Okay, well, maybe people just don't have as much disposable income, and that's what's causing this slump in revenue. So these are all things that you want to focus on. Now, if we're having negative year-over-year growth in revenue, does it make sense to pay a almost 31 PE ratio for Apple? I personally don't think that it's worth 30.1 price to earnings, but that's just my opinion. And sometimes in the stock market, or I guess almost all the time in the stock market, things will sometimes be oversold or overbought, and they can stay that way for quite a bit. So it might actually be overbought for several years, and then one day, you just see this massive sell-off when people start realizing, oh, okay, well, maybe the growth maxed out, and now, we're just going to go back to this PE ratio back around like 15 to 20, and that's going to be a pretty substantial sell-off. So just understanding all of these things just gives you a little bit more conviction in your holding time. So maybe right now, if you know that Apple price to earnings ratio is kind of high, you might be trimming a little bit along the way versus having this conviction to hold for a long time. Maybe you might just be trimming a little bit here and then allocating that money towards something else that is better valued. So ultimately, that's kind of how you want to look at things, at least in my point of view. And then another thing that you could also do is you could look at the technicals to go along with this. So I like to use this method. It's the MACD, RSI, and Fib retracement combo. So if we're looking at MACD, this is going to give you an idea of momentum. So when MACD crosses below the signal line on a longer time frame, more selling can actually occur. So right here in this chart, I know it looks kind of confusing, but I am looking at the 1 day chart. So basically one candlestick equals 1 day. So right here, this blue line is the MACD line. The yellow line is the signal line. So if you actually take a close look at this, the blue line is strongly below the signal line. And you can even see these values right here. So the MACD line is 0.89. The signal line is 2.18. So right now it's pretty heavily inverted. So when technical traders see something like this, you tend to see a little bit more selling pressure going on. And then along with this, you're seeing RSI of 33.21. So when you see RSI go down to 30, then typically people back off a little bit, because under 30 is considered oversold. So you can kind of see over time that this isn't really hitting sub 30 very often. So right when this hits around 30, it kind of rebounds, and then you see this overbought period. But we've kind of been in this overextended period for a while now. So maybe, it's entirely possible that we start staying in this lower RSI region, kind of like we did right here. So you guys can see that, it never really got up to those highs for quite a while. So we could just be in another slump like this. So who knows? But ultimately, if you're on the sell side, you would want to back off when we get to that 30 area. And similarly, on the buy side, you will want to back off when we're above that 70 level. Also, there's this saying not to buy something right after it sells off hard after earnings. And a lot of that has to do with the technicals because people generally want to see the technicals kind of reset. So over time, if the technicals don't really do anything and the stock just trades sideways for a bit, then you'll see that MACD line start to flatten out and it's less inverted. You'll also start to see that RSI kind of reach more of a mid level. So these are things that you all want to pay attention to, definitely along with the price to earnings, the revenue growth, and all of that stuff. So hope this video was helpful for you guys, and I'll definitely link the spreadsheet in the comment section, or not in the comment section, in the description section. So hope you guys have a great day, and hope you enjoyed this video.